Hi everyone, Milad Razai here, founder of Anchor Wealth Financial Planning based in Adelaide. Today we're going to talk about investments. We are going to talk about investing inside super. We're going to talk about the different asset classes that are available. We're going to dive deep inside of each one, and we are going to then talk about investing philosophies and talking about how it will impact your super long term, and basically what savvy investors are doing outside of super. Can that be replicated inside your super fund? So very interesting video coming up. Before we get into this any further, a disclaimer that this is all general in nature in terms of the information provided. None of this is financial advice in any way. It's not taking into consideration anyone's financial circumstances. So please do seek advice before going ahead with anything. Now, when it comes to investing inside super, now some of you probably sitting there going, well, am I actually invested? And contrary to the notion that, superannuation just sits in the background, does nothing. It's just this annoying scheme that was put forward by the government. It's actually a very effective investment vehicle sitting in the background, and it's basically getting those investing principles, time, compound interest. Now, if you haven't watched what that means, I have another video, so do go into the playlist and search that one up in terms of investing principles. It makes a huge difference, and most people's super fund is invested. When you start a new super fund, 70% by default, in most instances, is invested into growth assets. So the likes of shares and property in the way of REITs, so listed property. So this pretty much impacts everyone that has a super fund. Now, unless you've gone ahead and moved your whole super fund from being invested into a cash position because you're concerned about certain aspects of the market, I highly have always been against that idea, but whatever the individual is comfortable with, or you have made an investment decision, made some conscious changes inside your super, but not quite sure whether it's the right move, or wanted to dig a bit deeper, but did not have the information there allowing you to make an informed decision. Or if you are thinking about going back into the market and you're sitting in cash, then this is a very powerful video for you, and it can make a very big difference going forward, and in terms of what you will accumulate in your nest egg. Before we go any further, hit that button to subscribe and the bell button also, so you get notified when we roll out videos, as we are doing so every other day, so that you're notified. Let's talk about the different asset classes that are available inside your super fund. The first one, and what we're going to do, we're going to go up the risk, or another name, volatility, to return ratio. So at the core of it, we have cash right at the bottom. We have fixed interest. We have property. And then we have shares. So what we mean by risk to return, it's referring to the highest potential volatility, but the highest potential return in terms of shares, and then going down and down and down. So for cash, it's the lowest amount of volatility, but at the same time, the lowest amount of return potential. So We'll talk about each of these asset classes, and again, when you start your a regular super fund and you don't make an investment decision, a conscious one, 70% actually sits up here by default in most instances, and only 30% sits down here. So it's very much a normal thing for your super fund to be invested. So this is nothing out of the ordinary. Now, let's talk about shares. Which sit right at the top in terms of highest potential return for the highest volatility, and this is talking about short-term volatility as well, more than anything. So what are shares? What exactly are shares? And there's a lot of apprehension when it comes to shares because most people don't really have the information there to make a decision that makes them comfortable. But end of the day, what you got to consider with shares is people, most people, whether it's Australia or anywhere in the world, can't just get up and go and purchase a really big company. They can't just get up and go purchase a Facebook. They can't go buy a Woolworths. You just cannot do that for most individuals. It's just not going to happen. The finances are not there. So what do we do in that instance? How can we get access to these quality businesses that have been around for a long time and have done really well? Well, we can go into the marketplace, and that's what the share market is, and buy bits of these businesses. And in return, depending on the company, they reward us as investors in the way of sharing their profits with us. Just put company here. And we get access to their capital growth as well, because the share price is going up. So we go along that journey with them for these two areas. And it's really important to note that, because when you think long term, we are not focused on getting a price outcome in it for the short term to make a quick profit. We are going along with the journey with these great businesses. And what we really want is a lot of these two areas coming through, especially the profit side of things. And I'll go through that a bit further, just because it'll reflect really well with a lot of Australians, because they are already doing that, doing this inside another investment asset class. However, they most likely wouldn't know that it exists when it comes to shares as well. So again, make it really simple. Take away the idea that share investing is a gamble. That's short-term thinking. Long-term thinking, if you're invested in really quality businesses and you've got a nice spread of investment assets, and also at the same time have a good understanding of what the fund managers are doing, it's really, again, going, well, how can I get access to a really quality business? Well, I'd like to purchase a share of this business, share or bits of these businesses, and in return I can be to a certain point a part owner, and go along with this a journey with them. And it's a lot more fruitful if you think about putting your funds in a bank account and getting potentially a much lower rate long term into any banks out there, versus actually going and investing in those banks, and they would then share their profits, and you get to potentially be rewarded for their share price increases as well. So it's just breaking it down and it's taking a step back and just understanding what it's all about. Now, what I talked about before, the profit sharing. So you got income from these shares, and on the side you got the growth side of it as well. So this is so important to understand, because it's this aspect of it that makes people a bit uncomfortable, because all they're worried about is for that share price to go up. But like I said before, these businesses, they do two things. It's not just the profits. It's not just the capital growth that we're worried about. We also have this aspect of it all, the profits that these businesses make. And to talk a little bit more about this, if a company is generating profits, like I said, they are going to be sharing a portion of that with investors in a way of income. So even if the market's not doing well and the share price is down, they're still operating, they're still generating a profit most likely, and they are sharing those profits with investors. just like you would have in the property market. So when you purchase an investment property, and the investor is doing one or two things. They're either worried about the capital growth, the property price going up in value, or they're wanting that rental income, that beloved rental income. And this is that profit side of the share. You know, the investors, the company sharing back parts of the profits with the investors in the way of income. So if you want to think about the income side for share investing, it's kind of like that rental income for property investing. Um, and then the other side is, like I said, the capital growth, just the house prices going up. So when you break it down like this, for most people, they think, all right, well, that's actually quite interesting because it means that share investing and investing in these businesses in Summer Super, actually there is that breakdown of two different aspects, and the income can be very interesting for a lot of people. So long term, it's about going on that journey with these great companies and having a nice understanding of what you're investing in, and companies that have been around a long time, and going along that journey with them and getting returns upwards, 5 to 10% above the inflation rate. So that's very important to understand. Next asset class is property. We'll keep this one a little bit lighter. And in property, what we're talking about here is basically REITs more than anything inside super. We're not talking about bricks and residential property. We're talking about real estate investment trusts, and that refers to the investor investing in a company that invests in commercial property, buying shares basically in them. So it's still purchasing shares, share investing. However, it's a different asset that you're investing in, that it's a property. So this again sits in terms of the risk to return. We spoke about shares. Property sits second in terms of the potential volatility and potential return, and it just diversifies your portfolio. Again, you have that income side because there is the rental income that comes through, and then you have the growth in terms of the capital growth. Now, you don't actually own the properties inside a REIT. It's, again, buying shares, and you probably own units, and that would reflect your ownership. So very interesting. So you can be a property investor, and a lot of people are in their super fund, but they just don't even know it. So it's very powerful tool to get your foot through and get access to the property market. This actually came around, the REIT idea was done in the 60s in America, where they thought, well, how can we get the average person getting access to these massive commercial buildings? You can't just go purchase these multi-million-dollar buildings as your average Joe. So what do we do? This REITs came out, and it gives access to the average investor to go and put a little bit of money into an investment like a REIT and get access to property, because they're pulled together with other investors, and it gives them access to assets that they would not have had access to had it been just as a sole thing to do. So REITs, very interesting. Now, this is the listed part of property. But again, listed just means that it's listed on the ASX. Yeah, that's your second asset class. And then moving along, we talked about fixed interest. Now, fixed interest is probably it builds up about 15 to 30% of most people's super fund. It's very conservative. It includes government and corporate bonds, semi-government bodies and debentures, and they work like a loan from you to the bond or debenture issuer. And it's got a set rate of interest due to be paid to you at set intervals. And there is often a specific payback date. But fixed interest is basically, well, just think about the government. They want to go and do some, I don't know, roadworks or whatever, maybe a new project. They would want to borrow money, and they will borrow money from general public, and the investors would be the general public, and they invest in the government, basically, and they borrow money from the public, and the chances of the government not paying back is very, very low, defaulting, so the reward is quite low as well. So potential volatility very low, and the return also is the same idea there. It's quite a low potential return, probably 2 to 5% on average long term in that sort of space. So fixed interest would sit, like we talked about, the third lowest in terms of potential return and the third lowest in terms of potential volatility. And again, it forms a lot of Australian super funds. And the next asset class is just cash, so we won't get into that, but no different to putting your fund into a regular day-to-day bank account. Now, the way that your product works inside your super could be very different. So in terms of what I really want to get across today was that splitting of the growth aspect and the income aspect, because not everyone is aware. Everyone thinks about this space, the growth. My share price has gone down. Time to sell, it's gone up. It's a good thing. My REITs, my property REITs investing is again doing this. And I'm just going to worry about this. But this side is so important as well, understanding the income side, because like I said, this is like your rental income from investing in property. This is the potential dividends that you probably have heard before. These are dividends that are paid by companies to investors, and dividends is just another name for income. And it's something that's a little bit more potentially cemented, because like I said, these great Australian international businesses, companies are working, generating profits, and they're going to, in most cases, especially if they've been around a long time, they're going to share around 50% of those profits back with investors in the form of dividends and income. And that's what's going towards your super. Now, different super funds treat these income payments very differently. Some super structures, and I have to say most super structures have it bundled into the unit price. So it's very hard to see what's going on. There are super structures out there that unbundle this. And it makes a really big difference. Sorry about my handwriting. It's a bit interesting there. Getting to the corner of the page. Now, unbundled with the income versus growth side that we've been talking about today. Why it's so important to understand this is because you can actually build a super portfolio in terms of investments that are more focused towards income. They concentrate on getting you more of an income outcome and versus the growth side, or you can be focused more on getting a growth outcome, and the income would be a little bit less. So this is important, and a lot of Australians do, or investors have their own philosophies, and one would be sitting more here, another would be sitting more here. But as a first step, I think for the viewers, it's been a bit of a sort of a light bulb moment to go, hang on a minute. When it comes to share investing, it's actually broken down just like your property investing. When it comes to investment properties that Australians love so much, and a big chunk of the reason why they like it is because of the rental income. So if you can go down the path of building your super fund and taking away the philosophies of the income side of things and building on that and building a portfolio inside your super to focus more on getting you income come through, that could be something that suits the investor. That could be something that gets the person more excited when it comes to the super fund, or vice versa. Going down the path of growth and just wanting to really get that more potential high return in terms of the share price going up. So, and I really wanted to get this across because it's two different aspects of investing, and it's important to understand this because what it comes down to, and if you've got the structure of super fund that does give you this level of information, when you see your reports annually, you will see a business or a company. Let's change the pen color. The income for the year maybe was 5%. The growth was 5%. So the total growth was 10%. Great. We can see what's going on in a good market. Now, the market might have gone down, and let's just say COVID happened, and the same company a year later during COVID still gave you 5% of income, but it was a negative 10% in terms of growth and negative 5% total. So the income saves your portfolio potentially to a certain point, just because it's broken down and you are, as an investor, are trying to get this really across the line. So it's just really interesting when you break it down like this to go, all right, well, when it comes to share investing, it's not just 6 o'clock on the news and it's a big gamble and everything that most people really believe in terms of share investing. It's end of the day investing in companies inside your super, and they just like when you invest in investment properties, there's two aspects of it, and you need to understand this. So long-term investing, understanding income, understanding growth is critical for shares. Again, for even your likes of property inside your super, which again everyone to a certain point has exposure to. The same thing. You're going to have the rental income from your REITs and the rental income over here, and then you got the actual capital growth that you'll be looking into. So again, depending on the different structures of super fund out there, the main two different structures in Australia do this very differently in the sense of having it unbundled from the unit price, so you can see exactly what's going on, like we just spoke about here, not having it all bundled into the unit price. So this is what I was talking about at the start of the video in terms of the investment ideas and how it all makes a really big difference to your super fund. Because if you are different in terms of your mindset and your focus between these two, it can make a really big difference in the long run. So you can be a defensive investor and have most of your assets sit inside fixed interest, like the bonds that we spoke about earlier. You can be a balanced investor, and this is that 70% growth exposure that most Australians sit inside. Like I said, even when you open up a new super fund, and you have a lot of property and shares inside your super, 70%, or you can be a growth investor where it's about 85% exposed to property and shares, or you can be a high growth investor inside your super where it's 100% exposed to property and shares. So there's different levels of exposure, and you got to understand all of these have different long-term potential returns. When you go safer, it doesn't always mean a better outcome for a younger person or an older person. I mean, you got to think long term. You want to make sure that you are getting a return above the inflation rate over the long run, because if it is barely keeping up with the inflation rate and not really getting your return, that's also a cemented risk in the fact that your money is not working hard enough. So all of these things need to be considered. A lot of individuals think that, my money is pretty safe. It's not exposed to risk, growth assets. Growth assets. So that's pretty good. That's a good outcome. But if you're exposed to just this environment where you're getting potentially 2 to 5%, and the inflation rate is say 3 to 4%, that's just basically your investment inside super just keeping up with the price increase of milk over the long run. It's not getting your return above that, so it's not getting your a return that is going to be fruitful in the long run to allow you to retire comfortably. And you need to just really understand that, because if it's left in the my assets are safe and they're not exposed to these growth assets, then what's the real risk in that? And it's a cemented risk for most individuals that their funds are not working hard enough in the long run. Now, everything that I talk about in my videos, the key thing is long term. Long-term investing is real investing, and that's my philosophy. It's real investing. Short-term investing is not investing. Short-term investing is being driven by price and profits short-term, and getting an outcome, very short-term outcome, and that is not based on anything. It's just speculation, and that's not real investing. Long-term is going, well, let's invest in great businesses, great fund managers inside my super, and look at their track record for 20, 30, 40 years. And I want to be exposed to that environment and go along that journey with these fund managers, these companies, and for us, that's long-term real investing. If you want to find out more about the asset classes, what income versus growth means, how to go about building a portfolio, what's available out there, what the different super structures offer in terms of that space. And again, like we spoke about, what super structures out there offer that unbundling nature to you, so you can see your income from your investments when it comes to shares and property investing inside your super, so you get that transparency. If you want to find out a bit more about all of that and basically going down the path of making more of an informed decision when it comes to investments and having the investment philosophies back them that you're comfortable with, and there's a link at the bottom that you can book in your free 30-minute video strategy session with an advisor at Anchor Wealth. And it's a one-on-one, and we would go through your current super setup. At a high level, we'll talk about how it's potentially invested, what that means to you, what sort of structure you're currently in, and what's the available options.